Hello, thanks for joining us. I'm Eric Mancini, Partner, Director of Investment Research at Traphagen. And today we're going to talk about a new entry into the client portfolios, GPZ. And it is a special entry. This is an ETF or fund that we came up with the idea. We wanted to get into this theme, but there was no ETF or fund to do it. So we partnered with VanEck, a well-known ETF company, and together over the last 9 months, we did get the SEC approval for the ETF. It launched about a month ago, and now it's in portfolios. So we wanted to talk a little bit about the new ETF, the Alternative Asset Manager ETF, GPZ. Let's dive in here. So today we're going to talk about 4 things: the case of why we wanted to create the ETF, and for really alternative private asset managers over the next 3, 5, 10 years, the partnership between Traphagen and VanEck, and then we'll dive into the ETF itself. So we'll look at the holdings, some performance, and more details of the actual ETF, and then finally how we utilize it within client portfolios. So first, the reason we really wanted to dive in here is our firm is firsthand, in real life, this trend playing out. So back in 2012, 2013, we started with our first true alternative or private investment. That was insurance-linked securities. And ever since then, we went from basically zero allocation to private and alternatives to currently, anywhere from 30 to 40% in most client portfolios. And that has added a lot of value for our clients. And when you look around the industry, more and more RIAs or firms similar to ours, other types of institutions, family offices, and even retail investors, and it looks like possibly even in 401ks, if a couple laws go through with the Financial Freedom Act, this trend will continue into the future with large growth in private credit, private equity, private infrastructure, real estate, hedge funds, those type of things. And on the chart you see here is historical growth, obviously, from 2008 to 2024 has been a huge boon in these alternatives and growth, about 10% per year of these assets being actively managed or managed by firms. And we think that continues for the next 3, 5, 10 years. And along the same lines, when you dive in, you could dive into any one of these sub-segments. This happens to be private unicorns, which is the definition of that, is any private company that is valued at 1 billion or more. So if you go back just 10 years ago, there was only 51 private companies that were valued at 1 billion or more. For a variety of reasons, over the last decade, that has grown at 38%. The number of these $1 billion private companies or unicorns has grown at a compound rate of 38% per year. So right now we have almost 1,300 of these private, relatively large companies out there. And there's just more and more of a universe of private investments and companies and private credit, and frankly, less in the public space. And it's getting more concentrated in the public space. Still, obviously, the public stock indices and public stocks are incredibly important and the foundation for a portfolio. But more and more privates are becoming, on the equity side and the credit side, very important, and we're seeing that growth play out. And, when you look at, it's really a growth story. That's why we want to invest in there. This is why we want to invest in the companies that manage these assets, which we'll get to, but KKR, Blackstone, those type of companies. And you look at the past 15 years of revenue growth. So that's the chart on the left. Over the past 15 years, the S&P has basically doubled its revenue over the past 15 years. Traditional asset managers, so that would be Morgan Stanley, JP Morgan, Goldman Sachs, those type of companies, Raymond James, those have also doubled their revenue, so they're in line with the S&P. If you looked at Microsoft, which obviously the stock has done tremendously well over the last 15 years, that has 4x'd its revenue, so revenue 4 times, Visa 5 times, and it's basically a hidden growth story where these alternative and private asset managers have 6x'd their revenue. So they have grown more than Visa, Microsoft by a good amount and tripled the growth of the S&P. And I don't know if that pace can continue into the future, but certainly there's just an immense amount of wealth out there. And as the pyramid on the right shows, once you get to institution, endowments, pensions, and family offices, Family offices are generally 50 to 100 million or more in terms of one family's wealth. They allocate 40, 50% of their portfolios to private or alternative investments. The high net worth or mass affluent, depending how you define that, that could be clients of 500,000, a million, 5 million, anywhere in there, currently still only have, on average, 1 to 3% in private and alternative assets. If that can get to even 5 to 7%, let alone 10 to 15, then yeah, we have many, many more years of pretty substantial growth ahead of us in the growth of these assets and therefore the growth of the companies that offer them to us. In addition to that growth, these companies tend to yield a decent dividend, so we get a dividend of around 2% and growing pretty rapidly. So that's a nice side effect, if you will. It's not the reason we're investing in these companies or the theme, but it is nice to get the income and the growth in one investment. And that's the reason that we wanted to create this ETF. First looking at it about a year, 9 months ago. There's ETF for almost everything out there. This was one exception where there was no ETF in existence at the time in the US that purely invested only in these alternative private asset managers. So we shopped around to a couple different ETF companies, chose VanEck. They were very open. They worked with us in a great way. They moved fairly quickly. So we partnered with VanEck, and Traphagen VanEck created this ETF over the last 9 months. We got SEC, or VanEck and Traphagen got SEC approval about 2 months ago, 1 month ago when we launched June 5th with the ETF. It is open for anybody in the US to purchase at this point. And some of the companies, we'll get into this in a little more in the next slide, but the asset managers that do this almost purely would be Blackstone, Ares, Apollo, KKR. That's what is in this fund, owning the companies that manage these assets. It's a great business model. Again, these types of companies manage private real estate, private equity, private credit, private infrastructure. They tend to be very long-term assets. So investors come in, they own it for 3 years, 5 years, 10 years, even more possibly. So they're very sticky, predictable assets, and the fees are good. So these companies can earn 1.5%, 2% management fees for these assets. And if you get good margins, higher fees, and sticky assets, that is a good business model. Again, there was no ETFs, so we created this one and finally launched. And then over the past month, we have introduced this new ETF. Again, GPZ is the ticker, into portfolios over the last couple of weeks. And digging into the ETF, you'll see some details here. So on the left are the components or the individual stocks within the ETF. So Brookfield, which is a Canadian company, they specialize in private infrastructure along with private real estate. Blackstone does a little bit of everything. So they have a lot of private real estate, they have private credit, also private equity. KKR's specialty is private equity. Apollo's specialty is private credit. So each one of these firms you see on the left, purely alternative or private investments, and they each have, for the most part, their own specialties. Some of them, like Blackstone, do a little bit of everything. And you'll notice the ones that are colored, the light blue, would be companies we, as Traphagen, have a specific relationship with, and we actually utilize directly their underlying strategies, whether it be private equity with KKR, private real estate, Blackstone, private infrastructure, Brookfield. And then the Apollo, the Ares, and the Blue Owl, the darker shaded ones, we have an indirect relationship with, where some of the funds that we own their strategies underneath. So not only are we buying the companies on top, we're also utilizing their products. We believe in their products from the bottom up point of view. And then on the upper right, you'll see generally this is heavy US, so it's about 60% US exposure, but you do have some Canada and you have some Europe as well, as you can see there. The performance of the index that this ETF is based upon, which again, VanEck and us came up with the index and the ETF. If you look at, you back test it, you go back 3 years, it returned 13.7% per year total return. If you go back 5 years, it has returned 18.9% per year over the past 5 years. And then if you go to the bottom right, you'll see some other stats where it's a mix. It's mostly large cap, but some mid cap as well. So you get different types of company sizes in there. Almost a 2% dividend yield, so not incredibly high, but almost double that now of the S&P. And you see that top one where the expected future growth. And that's important to us, where we think this could certainly be in the mid to upper teens in terms of growth per year on revenues and earnings. One thing I did want to point out, just by the nature of these companies, and there's only 20 companies in the ETF, so it is specialized, it is concentrated. The volatility will be somewhat higher than the S&P 500 because of that concentrated 20 stock position and the nature of the industry. And that's why we utilized it in a certain way, which we'll get into on the next slide. But this chart here shows you the index, again, that the ETF is based off of. The ETF didn't exist for this long, but the index that it's based off, we went backwards, did a back test on it. And over the past 5 years exactly, 5 rolling years, the GPZ ETF Index would be up 160%. The general financial index, so that's mainly made up of JP Morgan, Goldman Sachs, companies like that, was up 148, and the S&P itself was up 117. So those all did well, but this specific index, looking at these alternative private managers, did the best and bested the S&P by a pretty good margin in that period. And again, we just put this ETF within client portfolios over the last 2 weeks, so it's been a very short period of time, way too early to really make any assumptions, but so far so good. Most clients are already up maybe 4 to 6% in the first couple weeks of ownership. And then how are we utilizing this? So we've purchased this in our balanced portfolios, the moderate growth and growth. So the 3 portfolios that are in the middle of the risk spectrum or on the more risk tolerant side, we did not purchase them in the most conservative just because it is a little more volatile and a little more market sensitive than most other holdings. So we did not purchase in a stable value portfolio or our capital preservation portfolio. And when we placed it within our balanced moderate growth and growth, we did so at a 2% allocation. So it's enough to be possibly meaningful to the portfolio, but even if the volatility gets there and starts to make this, if we get a market downturn, the volatility goes up, you're not really going to feel it too much in terms of the total portfolio. That said, if we do get, or when we do get a volatility in the markets, this could present opportunities where if GPZ is down materially, maybe even more than the market, we could use that opportunity to buy. And on the flip side, when we get a strong recovery, this could very well be up much more than the market, and maybe we could use that to trim it. But we would look to keep that core roughly 2% position. And that's basically all I have on this for now. I think that gives a good overview. But if you did want to dig in more, these are additional sources of information. So the top, in conjunction again with VanEck, VanEck has a podcast called Trends with Benefits, and they have a channel. This is also on most podcast channels, Apple or what have you, but there's a specific link there that you could follow. And if you go to that, the interview with me and the host, Ed Lopez, discussing this ETF and the trends behind it, and Traphagen, generally speaking as well. It's about a 40-minute interview, gets pretty in-depth. So if you wanted to tune in for that interview, that will be posted online, I believe, July 8th. And then also on VanEck's website, they have more detailed information on the index itself and the ETF on those 2 following links. And of course, any other questions, you could contact your Traphagen advisor or myself. Thanks for tuning in. Have a great 4th of July. Bye-bye.